Ted Oakley is following all this and the financial implications of all of this. He's with Oxbow Investors. Ted, good to have you. What do you make of this? And it's a reminder how much trade does dictate trading, doesn't it?
Well, it is, Neil. I think the thing about it, though, this has sort of been a relationship for investors like a Pavlov's dog situation where you ring the bell, they expect something, and then eventually you don't have any food, and that's where you end up. And I think that's what's going on now. And so they're really disappointed.
I'm that way with Ponderosa, but I digress. One of the things I noticed that was interesting is the better things look for trade, the better things look for stocks. In other words, the prospect that a deal could be imminent. This widened it out to pretty much touch, every good that we get from China. I guess the flip side hope is the longer this drags on, the more the Federal Reserve cuts rates to sort of buttress the economy. Do you buy that?
Well, I think they have to cut rates more. We felt like that all along. We thought they were off the mark yesterday. So I assume that by the time you get to October, November, that they're going to be up against the wall. They will have to come in and cut deeper.
So if you're cutting in an environment like this that saved the trade impact that's been minimal thus far, you don't have a lot of room here, do you?
You don't have a lot of room. That's one of the problems. If you look back, they were comparing it to mid-cycle, 95 to 97. It's not like then. That was a 6% Fed funds rate. So it's a different kind of game right now.
This global slowdown talk, it's always ignited every time you have an impasse on the trade. I was a little bit stunned to see oil just fall out of bed on the notion this is going to have a global impact way beyond the United States and China. Do you buy that if this drags on very long? That's exactly what happens?
Well, I do, because if you look at the Permian, you look at the Bakken, you look at the places where that's happening, we're starting to see a lot of supply, and I think that will have a big impact on oil during the summer. The
one thing I haven't noticed is that consumer behavior, while it's slowing from its highs, is still pretty robust. Consumer confidence still fairly robust. Wage gains in this country, maybe the underpinning of that, actually quite robust. So we've been able to weather this. How long do you think that lasts?
I would guess in the next 1 or 2 quarters, what you're going to see with the wage thing you're talking about is you'll be in a situation where wages will be going up. Profits will be squeezed, though. It'll have an impact on the markets in terms of stock prices. I think that's where the two are going to run into each other here.
All right, interest rates are going low, market rates are going low. This situation today, up to send, yields on a 10-year note, a popular mortgage instrument, for example, to fresh 3-year lows. What do you think's going on there?
Well, we said a year ago that, we felt like rates would be going down for the next 18 months, and we still feel like they'll still be going lower eventually. Now, they may break up a little bit here in the short run, but I think what's happening is you have a tremendous amount of debt right now, and when you have that much debt, it's really hard to push things higher. And I think with everything worldwide breaking, you're going to have a situation where we catch up with everybody else.
We'll watch it closely. Ted Oakley, thank you very, very much.